There's the team. I think, Dennis, you know most of the people. Who's new is Chris Hope has just joined us as an analyst. He's a mechanical engineer, so he brings some different skills to the table. Just to give an update on the philosophy, I mean, this is a high conviction opportunities fund. We have a value bias with growth at a reasonable price. We do fundamental in-depth company analysis. Importantly, we buy companies, not shares. We focus on the small and mid-cap opportunities, which hopefully provide faster growth. And we've got a private equity type approach and the importance of sort of time to allow the strategy to come through. Just in terms of the fund's performance, we launched in September 2009. Fortunately, we're the top line. And obviously the index there is the multi-asset flexible, which includes mostly big caps. So we've been able in a very difficult environment to keep ourselves ahead of the big caps, and I'll show you what's happened in a moment with all the small caps around the world. So we fortunately ahead of that. On the other small caps, we're unfortunately a little bit behind, but I mean, we've got the ShopRite transfer, which actually happened today. So if that had come through last year, which is what we were expecting, we would have been up there with these guys. So we will play catch up. And certainly in December, we had a nice run then. So just looking at some of the macro overview issues. This is really around, I think people are concerned about Eskom. As I said to you, the domestic mood when we last met was kind of somber, frustrated and worried, driven by load shedding. But Eskom have started delivering on this additional power. They've got 4,692 megawatts coming through between January and October 2024. So encouraging that they're ahead of schedule. Unfortunately, this picture looks a bit distorted. I took it on my phone recently at an Eskom presentation, but it kind of highlights all the different projects that are due to come through in the timelines. Looking at the private sector, because I mean the margins in this, in obviously power, are quite exciting. What we've got is the private sector bringing on about 3 megawatts a day, and that's mostly coming from the informal sort of private individuals like ourselves putting solar panels on the roof. That's the 3 megawatts. If we then look at the, sorry, let me just get rid of this. If we look at the formal market, which requires registration, so typically these are projects that need NERSA registration. They're typically projects that need financing, and they're over 1 megawatt. You can see there's about 12 megawatts per day being bought online. So can everyone just mute? I think there's someone that's not muted in the background there. What's missing in this whole mix, unfortunately, is a feed-in tariff, which is coming. Certainly, Cape Town have launched their feed-in tariff, which is at around 4 cents, which is well ahead of the NERSA number at of the Northern Cape, the big projects at 50 cents a kilowatt hour. So there's a significant margin. So that should help quite materially once that gets going, and that'll allow for a lot of these home projects, certainly that sit idle during the day, to feed power into the greater grid, as I say, with 3 megawatts a day being added. What we are hearing from the likes of Roynet is that obviously commercial demand has now been driven by price rather than load shedding, which is good to see. So I mean, the NERSA registrations in total came to about 4,530 megawatts over the course of 2023. And I mean, there's some big projects in there that it's still waiting to come through. So for example, Anglo's have got about 5,000 megawatts that they're busy working on, which they're going for registration shortly. On the wind side, winds are also an important, to back up the solar stuff, particularly because the wind is more prevalent in the morning and in the evening peaks when solar is unable to deliver. Unfortunately, wind requires wheeling. It's vast distances from where the consumption is, but we are getting the Eskom unbundling now, and which has happened, which allows for wheeling. And they've now handed out 4 wheeling licenses, of which Roynet is 1. So we should see a lot more of that wind start to come through as grid capacity gets added. On the macro side, we saw a nice rally in December and a bit of weakness currently. If we look at the rate expectations, so this, if we look on the left-hand side here on the Eurozone, what we're seeing is the next meeting, 25th of January. No expectation of a cut. But as we move out then to the next meeting, then thereafter in March and then April, you can see the percentages start to pick up quite materially for a cut. So, I mean, the market certainly is pricing for some significant cuts into this year after a very, very rapid increase in interest rates after they slammed on brakes after that inflation after COVID. On the right-hand side is inflation expectations in the United States. And again, you can see that the cuts are expected to come at the meeting on the 20th of March, and then thereafter, the 1st of May, you start to see those cuts start to come through. So, you know, this might happen a month or two later, but certainly they are on the way. In terms of global markets, I mean, what we're seeing at the moment is if we look at emerging markets versus US valuations, we're at the lowest since 1971. And that graph on the left-hand side shows emerging markets versus the US, the S&P 500. And this is from Bank of America. You can see the chart. And you can see it goes right back to find the same sort of disconnect in valuations with one standard deviation below. You've got to go right back to 1971. So it's not only South Africa that is cheap and frustrating. It's, you know, I think we get caught up in our local politics. This is an emerging market issue, and we're seeing it across the board. You know, China is taking huge punishment at the moment. If we look at that chart on the right, what that's showing is the US is near extreme peak versus global equities, and that well exceeding the 60s and 70s, the nifty 50s, and the 2000 tech bubble. And again, even if you look at that US market, it's a limited number of shares that have really driven this huge US outperformance. So I mean, the things that certainly worry me is if you look at this debt-fueled growth that you're seeing in the US at the moment. US government added $2 trillion, over $2 trillion of debt in 2023. They're running an 8% budget deficit, you know, and that just can't continue. So you've either got to cut expenditure, which politicians are not good at, or you've got to start hiking taxes. And I mean, across many of these large US names, you look at the tax rates are sort of at very low levels. So let's just see what we see happen going forward. If we then look at the small caps in particular, what you're seeing is European, you know, it's a chart on European small cap versus their large cap. And you can see that, again, you go back 20 years in terms of that you haven't seen these sort of valuations in the European market, small caps versus large caps. And the same thing then, if we look on the left-hand side there, this is a chart from Canada, a similar situation. And if we look on the right, that's the Russell 2000, which is the US small cap index versus the S&P 500. And again, you've got to go back to 2001 to see a similar level of valuation relative to small caps versus large caps. So the situation we find ourselves in South Africa is not unique. Looking then at the individual names, Grindrod's our largest holding in the fund at 13%. We will be forced to cut it at some stage. But, you know, as it stands at the moment, I mean, this is a monopoly type business with a failing SOE as its competitor. It's principally driven by, you know, surging demand for battery materials. You know, you're seeing it across copper, manganese, nickel, cobalt, graphite, lithium, and even coal going through these terminals. Also importantly, fruit exports are quite a significant part of the business. And there you've got, and that's the Maersk JV. There you've got by 2030, we're expecting volumes to be up by 51%. And that we know that because you can see the trees planted, and that's on the Agri SA data. Maputo is definitely becoming a port of preference for the Gauteng traffic. So I mean, volumes up 29% in 2022 and another 16% now in 2023. They've just reported that data this week. All the terminals across Grindrod are setting new records, and that goes from Walvis Bay, Cape Town, Durban, Richards Bay, I mean, right across the board. You're seeing new records be in all these different terminals. If we look at the Matola terminal in particular, so that's the picture at the bottom there, that moves iron ore and coal. That had a record last year, 8.4 million tons in 2023. And what they're doing there is they're moving that ship loader, which is running at capacity now at 8.4 million tons. They're moving that up to Walvis Bay. And then they're putting in a new ship loader that will load 16 million tons a year. So they'll be able to load a ship in a day with that new ship loader that's coming in. It's about a 1.1 billion rand capex. In Walvis Bay, you've also seen an explosion of volumes, and that's particularly coming through from the copper and the lithium iron exports. But the biggest kicker on the Grindrod side is we're still waiting for is this whole reform around rail. This is a 70 billion rand revenue opportunity. So that is the existing Transnet number and what they're leaving behind. Plus, we believe there's a lot more that can go into rail. Typically, margins internationally are at 50%, but we've been taking a little bit more conservative view at a 40% EBITDA margin. Our rail infrastructure, as it says, there's the size of Germany, but and in better condition than the rest of Africa. So it's not in the best condition, but it's certainly better than where Grindrod operate in Sierra Leone, where they move iron ore, the DRC, Tanzania, Mozambique, Zimbabwe, and Zambia. So they've got locos that operate across all those different countries. Fortunately, the track has been separated out of Transnet on the 31st of October. So, and they set up what they've called an infrastructure manager. So this is to allow the private sector to start running. So very simply, the track will sit in a new structure, almost like you've got the roads in South Africa that sit in Sanrail, and as long as you pay a toll fee, you can then move across that track. So that's the government policy. It's it certainly follows international best practice, and it's the right thing to do. So we're waiting. The next step is for the transport regulator to advertise for permits. Transnet themselves have to apply for permit, and that will then allow the private sector to start to move. So there are discussions around concessions underway. So very much along the same lines as you see on toll roads. So Sanrail owns the road, but for example, Tollcon is the concession on the N3 road to Durban. And as long as you pay your toll fee, you can use the network. So that picture at the bottom, this is from the University of Stellenbosch, their research department on rail. And I mean, important is right at the bottom there. So they talk about ton kilometers, which is the volume moved across rail. It's currently, last year was running at 18 billion tons. That should be up to 47. That's where they should be running. And looking through to 2050, you get up to 77 billion tons. And you can see, I mean, the demands there. You can see the trucks on the road. I mean, we've got the 11th largest truck fleet in the world because the volumes, these goods can't get onto rail. Then looking at Roynet, this is our second largest holding in the fund. 134-year-old industrial conglomerate. I mean, everyone's been focused on the infrastructure, on the renewable side. So there they make these solar wires for solar panels. It's quite a unique product because remember it needs to sit in the sun for 20 odd years. They also make the cables for wind turbines and for Eskom generally. Circuit breakers. So that's the picture on the bottom right. And if you do a solar project, you probably need another 30% of circuit breakers. But more importantly is this new, these software-controlled circuit breakers that are used for industrial applications, because industrial customers don't get charged on consumption, they get charged on spikes. And by controlling the spikes, you can control your power bill. And then obviously lithium-ion batteries. Eskom and Nedbank talk about in the next 8 years, there'll be about a 1.2 trillion rand expenditure going into renewable power. And that's why I just highlighted in some of those slides previously. But kind of the division of Roynet that no one wanted to talk about was the defense cluster. And this has kind of been hidden and in the business for many years. Obviously now with the Ukraine war and these assets becoming highly sought after, they've become a little bit more open to discussions. So you can see we're looking for about 568 million rands of the EBITDA this year out of the defense cluster. And certainly their order books are full and they're going flat out on it. So that's these businesses typically trade on about 15 times multiples. If you look internationally, and as I said, they're highly priced, and there's no debt obviously sitting in the business, so you can use the straight up multiple. So they're one of the largest fuse manufacturers in the world, and that's that picture on the bottom left there. So these are fuses that get screwed into artillery shells or into rockets, whole number of applications. You know, if you look at Ukraine, they're firing about 7,000 artillery shells a day. And so, funny enough, South Africa is one of the largest suppliers into Germany of artillery shells, and that 20% of those shells go with these electronic fuses. If you look at the picture in the middle, that they've got a very large radar business. So, for example, BAE will tell you that there's a 6-year backlog for radars at the moment. So, I mean, this business is also going flat out, and that radar is actually used for mining purposes. It's used and it's become compulsory in open cast mines around the world to monitor the slope. So that and they make those. And again, the order book is full on those. And this is the fund's second largest holding. One of the interesting stories that's playing itself out in South Africa at the moment is our desperate need for gas. So, I mean, there's two issues behind this. So the first is that, you know, you can't beat solar when the sun's up. At 50 cents a kilowatt hour, you can't, you know, there's no cheaper source of power. The problem is the sun sets every day. In addition, gas is needed to buffer intermittent solar and wind. But there's another big issue here going forward, and that is Sasol have told the industrial users that they are cutting them off from mid-2026. Now, if we look at that picture or the graph at the bottom left, what you'll see is that from this is the Pandy and Tamani gas fields in Mozambique, and you can see how they are declining in output. They're running out of gas in those fields. And so what Sasol are doing is keeping the gas for their own requirements, which are obviously much higher margins where they convert it to fuel. And if you look at that picture then on that graph on the right, what you can see there is you've got 40 picojoules coming in directly from Mozambique and another 24 picojoules coming in from Secunda. So that's 64 million gigajoules of gas supplied to industrial customers, and they're cutting that off from mid-2026. So the question is, where's this gas going to come from? And there's only two domestic potential suppliers as it stands at the moment. And basically South Africa needs an LNG import terminal. So if we look, this is the most recent update from Standard Bank that they did just recently. So if we look at the top there, you know, if we go up to, this is Namibia. This is the Orange River Basin where they've had these huge oil farms. There's Shell and Total. And you can see over here that Standard Bank, this is as I said, the oil and gas team who are the best out there. The expectation is the first gas will become available in 2028. That gas is going to be used to produce power. There's 3,000 megawatts of power. I'll talk about that in a moment. We then go down to the South African offshore. This is 11B, 12B. So this is the gas coming out of Bullprat and Leopard at Mossel Bay. That gas, we're waiting for the production license to be issued, but that, you know, the expectation is 2027. And then we drop down to the onshore facilities, of which there's really only two at the moment. You've got Renergen Phase 2, which is expected, they've got to do the capital raise now, we'll chat about it, but they've got to, that's expected to come into production by 2026. And that'll only be able to supply about 18% of what Sasol supply at the moment. So even though it's a biggish project, it's actually very small in the scheme of things. Then you get Connecticut further down, which is out in Mpumalanga. So they're well positioned. Standard Bank have them at 2027, but kind of talking to guys there and talking to management, you know, I think that's going to be further out. And then you've got the import opportunity, which is Matola, which is Total putting a platform into the back of Maputo Harbour and then bringing the gas in through the Romco Sasol pipeline. And again, that's 2027, but that's what then sets the price. And you've got quite a high price of that imported gas coming into South Africa. And then you'll definitely get a platform going into the back of Richards Bay, which will that's also 2027. And the reason why Richards Bay is for two reasons. So firstly, you have got access to the Lily gas pipeline. You can move the gas up from Richards Bay to Newcastle to Secunda into Gauteng, and then also into Durban. And the second issue is you've got power access to the grid. So remember, the eastern half of South Africa has got grid capacity. So the western half where the problems sit. And just on that score, I mean, that Matola project also, it is with Total. They are looking at a 2,000 megawatt gas-fired power plant that they want to put in there as the anchor. And then you can see further down what Standard Bank is saying here, where potentially they were looking previously at putting a floating platform into Saldanha. That's likely to be now piped, but you can see, I mean, that right out to 2030 and maybe even later. So, I mean, on that score, that, you know, brings you to Renergen, who will be the first in South Africa with some output of LNG. So phase 2 is going to cost $1.2 billion. US government are putting in $500 million of debt. Standard Bank are putting in $250 million of debt, and then they've got to raise $400 million on the NASDAQ, which I think we'll see that announcement coming in the next few weeks. That LNG will go into industrial applications and into the trucking markets. So again, if we look at talking about imported LNG, that gives you a kind of a peg. The bottom end there will be the 250 rand a gigajoule, and that's what they currently supply in Consol Glass and Italtal at. And then at the top end of the pricing, they'll be supplying the trucking markets at 470 rand a gigajoule, which is a 30% discount to diesel prices. So for the trucking guys who can convert their trucks to run on diesel LNG, this is quite a significant saving. And also you can't steal LNG. Diesel is obviously a major problem, theft of diesel for trucking. On the helium side, they've signed this deal with Linde at $320 in MCF for 50% of the output. The balance they're going to sell at the spot market. Look, the spot market at the moment is crazy. We don't expect it to stay at these sort of levels because you see major shortages around the world of helium. On our model, we've taken it a considerably lower price. I think it comes in an average of about $700. And that gives us 2.8 billion rands of profit on the project. And including the $400 million that still needs to be raised, so not the existing market cap. So for every 100 rand invested, including the capital to be raised, will give you 28 rands worth of earnings for the next 25 years. So, and that's why you've seen this private equity guys sticking quite a significant amount of cash into the project, because I mean the maths is really, really good. The helium is quite important because, and the reason why the US government are funding it is because it is semiconductors have been deemed a national security issue as well as helium. So the US government have got a $54 billion incentive package in place to get local chip manufacturing into the United States. And you're seeing $223 billion of plant being installed in the US at the moment by a whole range of different chip manufacturers. And those guys need helium. Now, for the US government, if you just look on the right-hand side here, you can see that this is the US, the BLM, they call it, which is a US government-owned facility that supplies helium. And the dark blue line, you can see the significant fall-off. So the US government is scrambling to find an alternative source of supply, and that's why they funded Renogen for the helium. You can see on the left-hand side there, if you look at helium demand, so you can see where the different applications, obviously, the stuff going to the US is going to be going for semiconductors, and a lot of it for on the purging and pressurization, which is what goes to NASA, and it'll be going to SpaceX and those sort of guys. So demand's growing at a significantly faster pace than you're seeing global GDP growing. So between 2 and 6%, and typically at the moment it's at the top end of that spectrum. So the other big story that you see playing out in South Africa at the moment is around HCI, Hoskins Consolidated. So up in Namibia, they've had seven major oil discoveries. In fact, the last one happened a couple of days ago. Gulp announced the very significant discovery. And if you have a look on this map here, this is where Gulp is over here. So and this is where HCI and Total sit, and this is the shell deposits over here that have been found. So the deal that HCI have done, they've essentially halved their holding, and on the back of that, Total will then fund the construction of the $16 billion capex. So their portion of the $16 billion capex, that $16 billion is to produce 400,000 barrels a day from 2 floating platforms. And that in turn will generate, on the numbers that we've been given, about $200 million per annum that'll then flow to HCI. So that's about 3.8 billion rand of free cash flow that'll be going to HCI per year going forward on that field. And it'll take probably, we're expecting FID to take place hopefully in the next couple of months. And that's why Standard Bank have got them in production by, you saw on the earlier slide, in 2028, maybe 2029, slippage into there. But HCI, more importantly, has got a free carry then on all the other drilling and exploration that takes place in the block and any further oil finds. And if you look at these dark gray blocks over here and down there and over there, these are the, and Mengeti, sorry, is at the top. Those are the, that's Mengeti, Damara Lead, and Damara South. And potentially, I mean, you can see them on the 3D seismics. That could be as big as Venus. And Venus is this yellow block over here. You can see where they've drilled those other wells. So these are quite significant. On HCI's balance sheet, this oil investment is carried at 1.75 billion rand. And as I said to you, you know, this thing will be generating cash going forward of 3.8 billion rand. So you're going to see a major revision of that number higher going forward. What's going to happen on the gas, because the gas is typically what holds these guys back, is there's going to be one pipeline that's going to go from Venus through the Shell up to Kudu and then onto the land. Kudu is owned by a crowd called BW Energy. It's a big, I think it's Canadian listed, a very large oil and gas company. And they are going to put in 3,000 megawatts of gas-fired turbines onshore there. Namibia currently uses about 650 megawatts, and they import about 250 megawatts. So Namibia goes from a country that imports power to a country that exports power. And this, as I say, is expected to happen in 2028. You have to get the gas out before you can start the oil production, because you're not allowed to flare the gas. So one of the reasons why you would expect to see significant power available going forward from, as I say, from 2028. On HCI's other assets, they've obviously got Southern Sun Hotel Group and Sokosan Gaming. Both those businesses are doing extremely well. And in fact, on the Southern Sun Hotel Group, we've just seen record bookings come through in December. So if you look for the full year of 2023, there were 2.8 million inbound and outbound seats into Cape Town, where they've got a lot of their hotels, and that's up from 1.5 million in 2013. So the underlying business continues to do extremely well, and we would expect a big re-rating in the share price as the market starts to understand what this whole Namibian oil and gas story is about. If we also just look at it, I mean, what's of interest is there's the border. This line here is the border, and below there is these are all the oil and gas deposits that then sit on the South African side of the Orange River Basin. And this is the one that the industry is very excited about. It's this 3B, 4B that unfortunately sits off Cape Town. So we'll see how excited the Cape Townians get. But this thing on the 3D seismics looks very big, and what the guys are waiting to see, it'll probably be drilled later towards the end of this year. Master Drilling is also one of our bigger holdings. Unfortunately, didn't have such a great year. It was down about 5% last year, which is very disappointing considering they've got full order book. Business is doing really well. They're a global leader in raise bore drilling. So for those of you who don't know what this is, you drill a hole down into the shaft below. You then attach a cutting head like that, and then you pull that cutting head back up to the surface, and that's the process in which you can develop a shaft very quickly and fairly cheaply. So only 20% of earnings come out of South Africa. There's an enormous amount of mines that need to be built going forward if we're to meet this whole move towards electric vehicles and renewables in the next couple of years. The share price at the moment, very disappointing, 3.5 PE. Doesn't reflect any of the disruptive technology which they've developed, and this is around the mobile horizontal boring machines and these blind vertical shaft sinkers. So, I mean, these machines typically reduce headcount, they reduce explosives, they cut out safety equipment that's necessary, and they take development from 3 meters a day to 9 meters a day. And essentially what that means is that the IRR of the mine gets higher. And secondly, you're able to access ore bodies which previously you were unable to access. They also own a business, 50% of a business called A&R Group. And what these guys do is they track 65,000 miners and 3,400 vehicles in South Africa's mines. The technology has now become compulsory in South Africa's mines. And they're looking to roll this out into other places around the world, in particular at the moment, Mexico and Chile. And really what it does is it's collision avoidance. So you could track, if you've got a problem in the mine, you know exactly where everyone is. You can then, if there's machines close to people, you can stop the machines. It's collision avoidance and being able to track for safety purposes where people are on the mines. So you can see there the 10-year average PE 11.4 and the current PE at 3.5, which is just way too cheap. So I mean, these guys have got some plans to unlock it. Let's see if they can execute on that. Metair was one of the big disappointments for last year, and the reason for that is that they won this Ford contract more than 4 years ago, and they've spent 4 years putting in all the capex and all the plans to launch this massive Ford contract. And it really is big. It's a 60 billion rand contract. So 6 billion rand a year. It's going to take production from 70,000 vehicles to 165. Sorry, I see there's a mistake there. It should say 12% margin. It's got 1. It should be 12. But Mete were hit with significant startup costs. So unfortunately, what happened was Ford made 2,000 changes to the vehicle 3 months after launch, and this just caused absolute chaos, and particularly on the wiring harness side, which is a very, very complex thing to make. And so the net effect is Ford have renegotiated with Mete and have provided some compensation. We'll see the numbers now when the results come out. But so hopefully that issue is now being fixed. And you should see this Mete start to benefit from this massive contract that they've won. On the energy division, look, so on the energy side, they make 9 million batteries. They supply into 40 countries, and they are looking to sell this business. They were well down the road of selling it when the war hit in Ukraine, and unfortunately, and you've also had some issues in the Turkish currency, and so everyone just took a bit of a step back, waiting for the war to end. But literally in the last few days, you've seen a new CEO being announced, and in there an unusual 36-month contract, and that just talks to this business being put up for sale and being sold. And you can see there it's to accelerate the key initiatives to unlock value for shareholders. So they're looking to sell the international energy division, which will go to one of the other big global battery businesses likely, and then they'll sell the local automotive components operation. So if you look there, we would hope to get somewhere in the order of about 40 Rand, which is not asking for a lot based on the forward numbers, which is about, on a P of 10, historic average P of 10. It's not asking for a lot. On mass real estate, it's also been also was disappointing last year because of the interest rates that got hiked very aggressively across Europe to rein in inflation. But the underlying story here remains extremely good. So, I mean, operationally, the like-for-like rental growth was up 12.6%. And remember, that's in euros. Distributable earnings were up 29%, again in euros. Footfall is up 21.5%, and sales per square meter up 18.2%. So the underlying retail business of owning shopping centers that they build and own remains very robust and very strong. Where the market was disappointed was really around the dividend being scrapped in the short term, and again that's just to get the debt down. I mean, it's one of the lowest in the sector at the moment at 28%, but it'll then fall down to 19% by 2025 if they don't pay a dividend by 2025, which we think that they will do. But within this business, you've got huge optionality on this residential property development arm where they make about 30% margin. So keep in mind, on the retail business, they build the assets to own themselves. On the residential side, they build these residential blocks to on sell and make 30% euro margins. Now, if you look at that picture at the bottom left there, this is what a Eastern European kind of communist era apartment block looks like for South Africans who haven't visited there. The average square meter per person is you can see there's 17 square meters per person. These things have got no insulation, single pane glass. Many of them don't have hot water. They don't have elevators. They're really, really horrible and miserable to live in. And these are people who are now living in the EU, have access to EU mortgages at very low rates, and want to live in modern apartments. And if you have a look on that picture on the right, this is taken from, I've been to the Silk District, it's called. This is where Mass doing quite a significant development. And that is retail on the ground floor, it's offices, and it's a lot of residential that they're busy building there. And there's huge demand for this stuff. People wanting to get out of these communist era apartments. So, I mean, a hell of an exciting story. Last year it didn't do well. It was down 16% at the share price level. But if you add in the dividend that you did receive in the first half, we're probably down in the order of about 12, which is not great for a business that's growing at this sort of pace. When it's growing its earnings at 29%, you wouldn't expect the share price to be down by that amount. So we do expect a big catch up there. Hulamin has been an interesting story. I mean, it's a 76-year-old business. It's got a history of strategic missteps under the previous management who then got removed. This new management team are prioritizing can body material, which they sell at $800, on a margin of $800 a ton, over what the previous management team focused on, which was hot band going to the United States at $20 a ton. So if you look at these last set of results, you'll see that volumes are down 7%, but profits were up 94%. And that was because you are focusing on the high margin product and not the low margin product, which is kind of talks to the missteps that the previous management team did. So, I mean, this business hasn't been able to achieve an acceptable ROE in the past decade, which is why it trades at a huge discount to its NAV and even its working capital in the business. But this new management team have got a strategy. They're putting in 550 million rands of the capex on 2 projects that'll lift EBITDA by 250 million rand. Essentially, those projects are all focused on this beverage can, where demand remains extremely strong, both locally and offshore. And most of that capex is going into the recycling. So they essentially will be able to buy scrap aluminium at 15,000 rand a ton cheaper than they buy virgin aluminium, which is 37% cheaper. And that's where you get this big uplift in profitability. So when these projects are completed, it'll take earnings to over 2 rand a share, and it'll take the ROE up to close to 20%, which is above the WACC of 14, and that should unlock significant value that's tied up in this business. So it's quite an exciting story, and look, we've been excited about it for a while, but this management team, the previous management team, just were not able to deliver. But these guys have now have a plan, and they're certainly executing it on it. Beverage can demand just continues to grow at a significant pace. You can see 5.4% compound annual growth. That is a global number, and South Africa is no different. And the reason for that is obviously the move away from single-use plastics and even from glass, which has got its recycling problems. And I mean, you can see the picture on the right-hand side of plastic bottles, and what Bloomberg's are telling you, you're drinking plastic fragments inside of plastic bottles. And hence why, if you go internationally, you're now getting water in aluminium cans. And so we would expect to see as this process unfolds, the share price start to re-rate quite materially, because a 2 rand of earnings on a current 3 rand share price does look rather stupid for a global business sitting in 2 of the fastest sectors of the world. So Nampak is a kind of a similar story. So I mean, they went through quite a significant shake-up. I mean, unfortunately, the management team going back 2 or 3 management teams ago went and made lots of acquisitions across Africa, where the demand is good, but it came with this complexity of African currencies, which has been a complete mess. Added to that, you had COVID, and the big alcohol businesses were forced to close, and ironically, Nampak should have just kept going, as well as all the beverage, as all the alcohol guys, but it left them in an environment where their debt levels were much higher than where they should have been. So the new management team that's come in has been focusing on operations. You've seen a significant cleanup. They're cutting debt. They're selling the plastics business. They're selling the paper business. They're selling the Nigerian can business. They're keeping Angola. So Nampak's got 8 beverage lines and 1 big food line, which is really important to the brewers in South Africa. I mean, AB InBev can't sell beer unless they've got access to glass and, more importantly, cans. And hence why this business, AB InBev, was so supportive in terms of them cutting their debt and really helping them through the process. So value can be established in several ways. I mean, if we look at, for example, Golden Era spent $71 million buying a second-hand can line, and Nampak, as I say, have 8 of these, so that's 10.5 billion rand roughly of can lines that they're sitting on. Their debt is 4.6 billion, so that leaves a value of 5.9 billion, and the current market cap is 1.6 billion, and that puts zero value to any of the paper and plastic operations or the food operation that sits in there. So the key now is to unlock the earnings, which management are aggressively working on. And, you know, if you look at the analyst numbers, they should get up to sort of 51 rand by 2026. It's a slow sort of build up. It puts them on a 3.5 PE. And certainly the activist shareholder that's come in and cleaned the business up, their plan is to make this business debt free and to sell it in the next 2 years. I mean, there's a number of big global canners that would like to come into South Africa. I mean, in particular, you've seen ARDA, which is a massive New York listed canning business, canning and glass business, but buy Consol Glass for 10.1 billion. And, you know, they could be one of the potential partners that look to buy this business. Okay, Donnie will give you an update on Carp Agri.
Thanks, Brendon. I'd just quickly like to talk to 2 new positions that we've added over the last 12 months. And the first is Cal Group and then Afrimat. And I mean, these 2 positions now contributes over 6% of the total portfolio as of today. But I mean, just starting off with Kel Group, I mean, many of you may know this business was formerly known as Kaap Agri. It has changed its name recently to Kel Group. It's a small business. It has about a 3 billion rand market cap, but we regard it as a little gem in the small cap space, very sensibly and well run. And what's quite interesting is you know, most people believe that this is a pure agribusiness, but this business has diversified away significantly, you know, from its agricultural industry exposure. And what's interesting today is that agri, or the selling of agricultural, you know, inputs to the farming community only contributes around 20% of trading profits, while the rest is made up of retail and fuel operations. Recently, you know, there was quite a strong expansion into fuel, and essentially the rationale therefore was, you know, exposure to the lucrative convenience retail sector. And, you know, only behind online shopping, you know, convenience retail is now the fastest growing channel in the space. And essentially what they do here is they essentially run, you know, fuel service stations. And what's quite lucrative about this is the fact that, you know, for a general, you know, fuel service station operation, 60% of profits is generated through convenience retail and only 40% through fuel. So, I mean, what's the investment thesis here? I think what's incredible about this business, and if you look at the chart on the right at the bottom, this is a business that has a more than a decade-long track record of consistent NAV and earnings per share growth. And if you look there, I mean, what's quite fascinating is over the last decade, there was only 1 year where this business did not grow earnings per share, and that was when COVID struck in 2020. And even at the time in 2018, when this business was still more heavily exposed to sort of agri and especially agri in the southwestern part of the country, this business still grew earnings in the 100-year drought that the Western Cape was experienced in that time. So, you know, I think what encourages us is that the business still has, you know, quite balanced growth ambitions, and they only prepared to grow the business at appropriate returns on invested capital. You know, we're encouraged by decreasing debt levels and improving returns on invested capital, and we think there's quite a strong possibility that, you know, future dividend payouts will increase as cash generation improves with the addition of the fuel operations to the business. And I think, you know, what encourages us even more is that we're buying this business on very undemanding valuation. So, I mean, as you can see below, again, the bottom right, NAV of this business is around 40 Rand per share. That's basically where this business is trading today. So you're buying it in and around book value on a forward P of sort of 5.5 times. And what's more incredible is that this business believe that they can grow profit before taxes at 20% per annum over the next 2 years, where they're chasing a profit before tax target of 1 billion Rand by financial year 2025. And just moving on to Afrimat, Brendon, thank you. Another gem in the small cap space, with a market cap of just below 10 billion Rand at current. And again, you know, a story of a business that has changed a heck of a lot over the last 10 years. It essentially 10 years ago was a business that solely focused on the construction materials segment and industry, and these days it's more of a junior miner. And I mean, if you look at the chart on the right, and this is a graph that I just took from an Afrimat presentation, a results presentation, you'll see the blue line there approximates how earnings would have grown over the last 15 odd years if they hadn't expanded, into the resource space from within construction materials. And you can see that this business essentially would have gone nowhere over the last, sort of decade. And, through, I think, the vision and shrewd deal making from management, this is a business that is actually for a company operating in this space shown very smooth earnings growth and high returns on invested capital, which we tend to like. So, I mean, as going back to, what they own, the diversification sort of saw them buying assets in iron ore and most recently anthracite. And, iron ore, which is still contributes over 80% of operating profits, is expected to reduce to less than 50% over the next 10 years or over the next 2 years, as this new projects that they've embarked upon takes effect. So iron ore, basically, 50-50 split in terms of sales between domestic and export. And what's also nice is they do have some support here where domestically they sell iron ore at a fixed price to ArcelorMittal, and on the other hand, the other 50% they get exposure to the iron ore at dollar pricing, where both operations are very much equally profitable because of a very low cost operation that these guys run. So recently they announced a big acquisition of a business called Lafarge. Lafarge is an aggregates business, much the same as the assets they already own in the construction material side of the business. These Lafarge assets is well located. It's got reserves greater than 30 years. And I mean, it talks to the what we've seen from this management team over the last decade, where they've got a very strong record in buying struggling businesses or businesses that they believe they can integrate. And this one, they think can add 500 million rands of EBITDA over the next 2 to 3 years, which would imply that they paid 1.5 times EV to EBITDA for it, which means that it could prove to be highly profitable and that at an extremely generous price tag. So what's the investment thesis here? I mean, again, we're talking about a highly regarded management team, which has a good record of capital allocation. As I said previously, I mean, for a company operating in this space, they have shown very smooth earnings growth and that at high returns on capital in a very difficult environment. We think these assets that they own are actually quite uniquely positioned, and through the shrewd deal making, we are seeing them improving the quality of the overall portfolio. So I mean, they pride themselves that they operate in the mid-tier mining segment, and what gives them an edge there is that they take on projects that's too small, projects for small players. That's too complex for small players, but then too small for the larger players. So they face much less competition in that mid-tier mining space, and that gives them an edge applying their trade there. So we think from this point forward, there's expectation for strong multi-year earnings growth per share as these new projects that they've embarked upon are bedded down. And I think something that we are starting to see early signs from is that there are green shoots from construction activity, especially in roads from Sunroll side and in rail from Transnet. And these guys are extremely well positioned to benefit from this uptick of activity in the construction sector in South Africa. And then you also have got optionality, I think, in the case of a secular upturn in commodities. So I think that concludes it, and just our rationale for adding these two investments over the last 12 months.
Yeah, thanks, Donnie. Yeah, just to wrap up, I mean, if you have a look at across some of the holdings, these are obviously not some of the property names, but I mean, if we look at the PEs of where they are versus the 10-year median and average, I mean, you can see that many of these names have significant upside. I mean, even going down to like an Avitech, for example, which has been a fantastic performer for us. The average there you can see is close to 20 times, and that's education businesses globally on that sort of space. So these things remain very cheap, and that goes back to the comment about European Canadian, US. We're seeing this theme all over with these small caps being incredibly cheap. So then if we look at expected returns across the portfolio, so I mean, just starting at the top here, just to explain how this works. So, you know, for example, this is Grindrod. You can see we had a big weighting, 13%. It's done phenomenally well for us. Where kind of a target price in the short term is, or medium term, that gets us a 49% return. And if we look down across the whole portfolio and in terms of that weighting, that gets us to a 60% return that we're looking for in the portfolio. And that includes some negative numbers. I mean, if you have a look here, I mean, just looking across, just trying to pick up one or two few, like an Afrimat that Donnie's just spoken about, we're expecting to see some revisions up and for these earnings to start to come through, and we'll start to see that chip the target price move. And even down to, I'm just trying to see what this negative 1% one is. That's like, for example, Libstar. I mean, Libstar's, the deal has to happen this year. The Actis, the private equity guys, and 37%. It has to be sold out by the end of this year. So we want to see it being bought by the Premier Group. They've got great management. And we think that there can be some, and they can unlock significant value in this business. I mean, it's also trading at a very low level. So, I mean, that includes some negatives, as you can see down there. And then if we have a look, this is the ShopRite I spoke about, which was meant to come through last year. We've been working on it for about 3-4 months to get these shares through onto the portfolio, and I think, in fact, today, I think the Netbank, the administrators, are telling us that the shares were arriving today. So that would have unlocked that value. So I mean, that gives us a total of, as I say, 60% return that we're looking at across the portfolio as it stands at the moment. In terms of the M&A activity that we are seeing and expect to see, I mean, Grindrod, there's been lots of talk about something underway at the moment. I mean, certainly you saw Remgro unbundle it. They did it for a reason, because they had a number of parties approach them for a cash purchase. HCR, as we've spoken about, Hammerson is looking to sell it's called Value Retail, which could unlock significant value in that business. In future, we would expect to see Roynet, that talking about the defense business, something happening there. As I said, on Master Drilling, there's been lots of talk about potentially a Canadian listing. Libstar mentioned the private equity Actis, which has been sold. The deal has to happen before the end of this year. And we understand that they're in talks with potentially 4 parties. Renogen, I mentioned, is for this NASDAQ listing. ShopRite is the movement of shares, which we've seen. Hulamin have had numerous approaches, but they are obviously will want to get these earnings locked in before they start discussions again. Mete, I mentioned, there was a commentary that came out a couple of days ago, and then Premier is looking to acquire, and hopefully we're keeping our fingers crossed that they actually are the ones who take Libstar. So, I mean, why invest in this fund? It's uncorrelated to the bigger names that you're seeing that most trusts hold. It's a high conviction quasi-private equity. You're getting very cheap valuations at the moment. These are unloved, undervalued opportunities, which typically the bigger unit trusts or investment firms can't invest in. We've got a successful track record of activism and unlocking value over the years. And yeah, I mean, we look at many of these stocks that have got limited debt and can do share buybacks. And a great comment at the bottom there: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So we're certainly not in the euphoria stage at this point. We certainly on the valuations are down at this pessimism level. So I think that wraps it up. If there's any questions, I mean, there's a sort of the last page. If there's any questions. Dennis,
I just want to say I really appreciated that rundown of everything. It's a fantastic summary of where we are.
Okay.
And I certainly like the last slide. The one with a 60% return. I love that.
Perfect. Well,
good job, guys.
Okay, thanks very much, Dennis. Mr. Yates, you got any questions?
Come on, Chris.
Can see you there. I think he is on mute. Okay, perfect. Well, if that's it, thanks very much, everyone, for their time. And if you've got any questions, just give me a ring. You've got my cell phone number. You can give me a shout.
Appreciate it, guys.
Okay, awesome. Thanks very much, eh?
Cheers.
Cheers. Bye-bye. Bye.
Thank you. Bye-bye.